Okay, good morning everyone, and welcome to what is now the 14th edition of the Coffee Microcaps morning meeting. I'm just going to quickly run through some introductory slides and then we're going to get straight into it to our first presenter. For anybody who hasn't joined us before, my name is Mark Tobin. I'm the founder of Coffee Microcaps and I'd like to welcome you all to this morning's meeting. And disclaimer. For anyone who hasn't joined us before, just to give you a structure of the webinar, we generally do these every fortnight. We've been doing them actually every week for about the last month. We get two companies in to present their story, 30-minute slot for each, comprised of a 20-minute preso and a 10-minute Q&A. If you do have any questions for the presenter, please type them in the Q&A box in the control panel, probably at the bottom of your screen. Please don't use the chat function. The Q&A function is actually a lot more easier for me to moderate and for the presenters. Please note that the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel probably over the weekend or latest on Monday. So if a presenter skips over a slide a bit too quickly, you can go back and rewatch it. You can also go back and watch any of the 13 previous webinars that we've had, which now encompasses well over 20 ASX microcap names. To follow us, if you don't already, on Twitter, YouTube, as I said, for this webinar and the previous webinars, LinkedIn, where I do some additional long form content. I also write a subscription newsletter covering ASX microcap stock ideas, and that can be accessed via the Substack platform.
Thank you, Mark. There we go.
I can see your cover slide now, Steve.
You can see it. Terrific. Okay, great. Okay, thanks, Mark. Well, I'll get cracking, and thanks, folks, for taking the time today to hear a bit about the Acrow story. Okay, so just give you today a quick background of the business over the last 2 years since we listed in April 2018. Some of the major developments over that period, an update on the FY20 results, and also what we're seeing as the outlook into the new year. So firstly, just to describe our business, we are a leading provider of engineered formwork solutions and scaffold hire across all of Australia. The business was a long-term asset of Boral, sold into private equity around 10 years ago and taken out of private equity to listed in April 2018. So just on this first page to give you some of the highlights of the business at the moment. Firstly, just in terms of our share price, particularly pleased at the moment that our current price is as high as it's been for the last 18 months. You can see we're listed at 20 cents. We're trading sort of circa between 35 and 38 at the moment. And certainly since the COVID sort of hit of about 6 months ago, we've had extremely strong bounce back. And, I think we've probably bounced back as well as anybody in the construction sector in terms of our share price. We operate in 6 states and 10 depots, 1,300 customers, 245 employees. Market cap is sort of circa about 80 at the moment. Our annualised revenue going into the new financial year that we're in at the moment will be a bit over 100 million. We've got $130 million replacement value of assets. As I mentioned, we listed in 2018, and just safety, which is obviously a very strong focus for all businesses, but for us especially, we're very proud of our safety record over the last 4 years that we've measured that we've gone from high sort of 19.7 lost time injury frequency rates to 2.4. I mean, that's representative of only 3 lost time injuries in the whole of the business last year. So very pleased with that result, clearly. The broad strategy of the business, firstly, we want to become, and we're very fast becoming, the leading engineered formwork sales and hire equipment solutions provider in Australia. I'll talk a little bit shortly about the pivot that we made 2 years ago to focus less on residential and commercial construction and more on civil infrastructure construction, and how that's played out in the business and why we think that's been so important to our success. Second point is we've now got a very strong focus around the industrial scaffold market. So it's quite a different market to residential and commercial. The major differences between, if you like, formwork, civil infrastructure and also industrial scaffolding versus residential and commercial is it's not a price-driven market primarily. The residential and commercial access scaffolding market is very, very price-driven, very commoditized, not a lot of differentiation. However, in industrial scaffolding, where you're dealing with oil and gas and power stations and mining, where it's what you're doing is providing access equipment for major shutdowns, safety and quality, and all the things that are also important in formwork into civil infrastructure is very important also in the industrial market. And one of the acquisitions that we made last year, Unispan, has given us an entry into the industrial scaffold market. The returns are tremendous, and we now want to grow that nationally. Recruit, train and retain the best management engineering talent. Engineering is incredibly important to our business. We employ now roughly 30 odd engineers. Our national engineering manager is a 30-year-old guy who's come out of our business over the last 8 years. Our engineers are focused on customer solutions. They're not, whilst their technical ability is high, they work with our clients to get the best possible solution. So it's a real value-added part of the business. In a lot of cases, it's our engineering smarts that actually wins us the work on some of the major projects that I'll refer to a little bit later in the presentation. We've now got great organic growth opportunities. I'll talk shortly about the two major acquisitions, or the two acquisitions we've made since we became a public company. That's now given us ability to open up new channels for hire and sales of products into markets that we've never previously operated those sorts of products in, and the businesses we bought also didn't previously operate. But because of our geographic spread, we've got the ability to open up a whole range of new channels, and it's actually working extremely well at the moment. And finally, we are an acquisitive business. We've made 2 acquisitions, and we are still on the lookout for others that fit the mold of exactly what it is that Acrow wants to do with our it helps us meet our mission of becoming that formwork, leading formwork company and the leading engineered industrial scaffold company. Key financials for last year. Our revenue of 87 million was up 22%. I mentioned that we go into the new financial year now where we'll be over 100. We had a 8-month contribution of an acquisition of a business called Unispan in that last year. EBITDA pre-AASB, which is still at the moment to me far more important than the other, $15 million, up 30% on the previous year. NPAT of 9 million was up 20% on the previous year. Our net debt did increase by just under $11 million, and that was effectively the cash, a bit less than what the cash was paid out for the acquisition that we made. EPS went up by 5% to 4.6 cents per share. We declared a 1.05 cents dividend that we're paying in a few weeks, and operating cash profit also up 27% to 11.2 million. So another very strong year, and I'll show shortly in the presentation that the 7th year in a row now of growth of profitability within our business. So I'm going to focus on 6 major points within over the last 2 years that have helped get the business to the position we're in today. First one I mentioned was this pivot away from residential and commercial scaffold and more to civil infrastructure, primarily in formwork. You can see on that chart that it's basically turned on its head over the last 4 years. So when we became a public company, we had circa sort of 50 to 60% of our earnings were coming out of commercial and residential scaffolding. That's now 25%. So in the financial year just completed, we had 75% of earnings come out of formwork and industrial scaffold, and only 25% in residential and commercial scaffold. The one thing I will say about that residential commercial market is, and I heard Jim speak earlier, and he's correct. It's been in a low point for probably the last 3 to 4 years. We're probably not as confident. Well, I think it's uncertain how quickly that will return. Clearly, it will return at some point, but I would describe that at best as uncertain. Whereas the formwork business and the civil infrastructure pipeline is not uncertain. That's extremely strong. I think we've actually got a 2-pace construction economy now in Australia. If it's government funded, you're going to be in for a good time. If it's privately funded, it's uncertain as to how you'll go for this next period. But we're very fortunate that we made that decision 2 years ago, and now the impacts of COVID have made that even a better decision. In that we're now on a range of major civil infrastructure projects that are going at a cracking pace. So that's been a successful pivot. And it's an area we want to continue to concentrate on again, the formwork part of the business is highly engineered, it's a specialist area. It's every job has a difference to it. It's really customer solution orientated work rather than you know, I don't want to underplay the requirement for scaffold around a building, but access scaffold is not the most important part of a construction. But when you're propping up the laying of concrete in, you know, bridges and tunnels, etc., it's incredibly important that you get the whole process right. Second thing I want to focus on here is I think we've now positioned ourselves incredibly uniquely in the Australian market to be able to offer the range of services and products and service the different markets that we can across the whole of Australia. And look, there is actually no company in our particular space who's in formwork and scaffold hire who actually operates across the geographies that we do and operates across all of the product ranges that we do. I mean, there's companies that are national, but they just do scaffold. There are companies that are almost national, but they just do formwork and they don't do any scaffold and don't do any industrial scaffold. We also have a screens business, Natform, that we've purchased. You know, we don't really have a national competitor in the screens market. So, you know, I think it's one of the major competitive advantages that Acrow has is the geographies that we operate in, the network that we have, and the ability to move product around and you know, and now open up significant new channels for growth that I'll touch on shortly in relation to some of the products that we've now got as part of our range via the acquisitions that we've made. So we have made 2 acquisitions since we've become a public company. We purchased a business called Natform in August 2018. They provide protective screens on medium and high-rise developments. So that's, you can see in the photo there, that's actually the Opera apartments being built, which is just about complete at the moment. The screens that are on the top of that building are provided by us. Effectively, the screens move up with the building rather than scaffold that has to stay sort of from ground up. So this is a product that has now become sort of well accepted nationally. Natform was one of the pioneers of that. The business of Natform was owned by one owner for about 25 years since she started the business. She still actually is now a director of the public company for Acrow. That sort of screens market has now expanded. There's a number of players, but I think, you know, Natform brand, certainly in New South Wales and Queensland, has been the market leader for a long period of time. We now have a great opportunity to develop that product across the country. We've opened up a business in Victoria that the previous owner did not have. We're already doing extremely well out of that. We've done a couple of jobs in South Australia, and we've got our eyes open in WA and Tas. It's fair to say that there was a reasonably slow start when we purchased this business, but we've really hit our straps in the last 6 to 9 months. We've had our highest profit quarter since the acquisition in the fourth quarter of 20. That's continued into the new financial year. And you know, as at the end of September, we'd already secured about 50% of the annual budget for this business in new work, including the job that I mentioned there, $1.1 million job with Meriton's Parramatta. That's the biggest single screens job this business has won in its history. We've got some great young, enthusiastic management in that part of the business now, and you know, I've got high ambitions to grow that further. It also allows us to enter some new products that complement the screens. We've now got a handrail product that we've developed that goes hand in hand with our screens, and you know, it's really, as I said, after a reasonably slow start, I now think this is one of the real sort of benchmark parts of the Acrow business going forward. The other acquisition that we made, which is completely transformational to the whole of the Acrow business, was to purchase Unispan in October 2019. Unispan were primarily a Queensland-based business, about 90% of their revenue in Queensland, a little bit in New South Wales. Highly complementary formwork equipment to Acrow. The photos that I've showed there is actually a job that we've just completed in Townsville, which is a site called Sun Metals. It's a zinc refinery, and what we're doing there is basically providing the support for the development of another part of the refinery, and that's a combination of using Unispan equipment and Acrow equipment together. Now that, you know, previously obviously we wouldn't have done that. Unispan would have had to hire or cross hire from somebody, and we may have had to cross hire if we were going to do the job. But we were able to do the job completely using gear from Unispan and Acrow. And then also, as I mentioned, that the acquisition has brought us into this industrial scaffold market. Now, it's only focused in Queensland at the moment, but we've got strong ambitions to grow that business nationally. We know we can. We've got an excellent reputation as a service provider in the Queensland market for industrial scaffold. We just won recently, we'll re-won our Origin Energy contract that generates about $5 million a year of revenue for another 3 to 5 year term in Queensland. The other very attractive part of this acquisition to us that's has been the game changer is that our major competitors in the formwork space are all Australian subsidiaries of European manufacturing companies. Now, we as Acrow, we previously, whilst we were a strong formwork company, we didn't have any specific relationship with a manufacturer that allowed us to stay at the cutting edge of development in this industry, because it's a very, it is a dynamic industry. Unispan had the Australian distribution rights for Olma, who are a Spanish manufacturer of formwork equipment. We now enjoy that arrangement. We've entered into a new agreement with Olma that also now includes New Zealand. So we're the sole distributor of their products in Australia and New Zealand. That gives us a significant edge, and it's opened up a whole range of other opportunities to us now in sale of product as well as hire of product that I'll touch on shortly. The other thing about the acquisition is that it was a true integration opportunity. There's over $2 million worth of cost outs that we've now successfully achieved. For example, Unispan had 3 depots, 2 in Queensland and 1 in New South Wales. Of those 3 depots, 2 of them have been closed, and we now only operate 1 of their depots in Queensland. So we're able to consolidate all their other work into our existing network, and that saves sort of circa $800,000, $900,000 in rents. So it's been a very successful acquisition. Very good people have come out of the Unispan business into Acrow, and again, I think this is the real transformational thing that's happened to our business over the last 2 years. I mentioned another year of EBITDA growth, so you can see from this chart going back to 15, every year we've had a better result than the previous year. Every year the margins have improved. And we go into the new financial year. We're obviously now 3.5 months through. This story is continuing. So we pride ourselves on continued growth. Definitely got solid contributions to the 2 acquisitions, but we have also invested fairly significantly in capital in the formwork part of our business, and we don't get less than 40% returns on any of the capexes that we for growth that we've purchased over the last couple of years in our formwork area. The other thing that's emerging, and it's really actually been quite interesting that it's really emerged in the last 6 weeks. We've known it was a possibility, but now it's starting to happen. Unispan were definitely better than Acrow in terms of their purchasing ability, so purchasing both capital equipment and sales stock and maintenance stock. Definitely Unispan had a better program for that than Acrow did. We've now got one of the previous owners from Unispan as our national procurement manager, and it's been quite amazing how much better he is buying than what we had seen in the past. So we're now seeing significant benefits, and I'm talking as recent as our current sort of forecast for our current month's P&L for products that we purchased for on sale, where we're buying now for sort of anywhere between 10 and 30% cheaper than what we were previously. So that opens up a lot of opportunity for us in terms of either growing margin or growing volume, or a combination of both. So that's very pleasing. We thought it was going to be an opportunity, and it's now definitely coming to the fore. This I was going to put a slide about COVID, but I decided not to. I sort of thought I'd touch on it here, which is around what our current pipeline looks like and the work that we've won over the last period. It's actually been pretty remarkable, really, that in this period of uncertainty, we've actually had our best 6 months in terms of new hire contracts won. You can see the second half of 20 was up 62% on the same period last year in terms of jobs won, and the pipeline is significantly up. We haven't had to shut any depots. We haven't lost a day in Victoria. In fact, we go from strength to strength in Victoria at the moment on all the major civil projects. So it's been a very good story for us over this period. We did a range of cash saving measures early. We got 6 months deferral on our principal debt payments with our bank. We got a whole bunch of rent reliefs, saving around about $1 million in rent payments by renegotiating the lease terms to give our landlords longer term certainty so we could secure some short-term rent-free periods. We've had a very good period over this last 6 months. And the hire contracts in the current pipeline are a strong indicator of the success of what's been going on over that period. A few of the major jobs we're on, I mean, it's been a big turnaround for this business in the last 2 years. We're on the biggest civil infrastructure projects you could think of in the country. And here is just some examples: Sydney Metro, Melbourne Metro, the Melbourne Western Distributor Road contract, freeway development, and now starting on Snowy Hydro. So we're well positioned, and we've had a lot of success on all of those major projects. Snowy, it's very early stages, but I'm thrilled that we've supplied the very first formwork equipment onto that job. We've basically provided the launching pad for the tunnel boring machines that are going through that right now. It was a small sale of $300,000 worth of gear, but it's very important to be the first player on that job, and that is the major civil project across the country, probably over the next 5 years. Further to that, just, some of you may have seen this sort of stuff before, but it's still very relevant. Civil infrastructure is by no means at its peak. You can see where we are at sort of mid-2020 to where we'll be by 2023. So there's still significant growth. I'm pleased to say that almost all of those major projects that are on the right-hand side of that page, Acrow's got a strong foothold on now, some more than others. The major rail projects, the next big one to kick off is the Cross River Rail project in Queensland, where we'll start seeing significant revenues probably in the early new year from that. But this is the story, and it's not changing. And again, given the government support for this space, it's going to only get better in our view. State of the markets, again, just give you a quick indication of what we think at the moment. Civil is very strong in Queensland and Victoria. We're in a bit of an abeyance in New South Wales as some of the projects that have been going for the last couple of years stop and others start. But across the country, civil is very good. Commercial is reasonable in everywhere but probably WA. Residential is, in our view, very soft in Queensland and New South Wales, and sort of stable-ish elsewhere, but very soft still in Queensland and New South Wales, and thankfully it's not that relevant to our story anymore. So into the outlook for the new year, Q1 trading has commenced in line with fourth quarter 20, albeit actually a little bit better than we thought. So we're now 3.5 months in, and we're a reasonable point ahead on our budget to what we expected. The Melbourne lockdown had absolutely no impact on us whatsoever. Civil infrastructure continued, and we actually have had 2 months in the months of September and now looking like October, where we've recorded record high revenue numbers in Victoria for the business. So that's been obviously very pleasing. We've talked about the new sales that we've secured over the last 4 months. Into this year, that the main drivers for further growth on our profitability will be the 12-month contribution now of Unispan instead of 8, including all of the cost outs, getting the full year benefit. This opportunity to develop our products across the country, expand our capabilities and offerings across all of the country. We're now really focused on opening up new channels. It's so important to the business where we can open up a channel for sales and hire that we didn't previously had off the back of the range that we now have. Talked about civil infrastructure projects. Our sale of product now has become very important to the business. We've just launched an online sale. So we're talking about sales here. We actually sell timber and ply in a small way, competing with Big River in a very small way. And we sell a range of other products to form workers. And it's now, I think, we'll have probably $30 million of revenue coming out of sales, up from probably 10 or 12 months ago in the next couple of years. There is a rebound in activity from industrial. There was some of the shutdowns in the industrial market in Queensland were delayed. They're now being reactivated, and we're continuing to get very good growth out of the Natform business in New South Wales and Victoria. And as I said, I think there's a risk in the commercial residential area, but again, I'm going to couch it as being uncertain rather than good or bad. The two brokers who cover us have a current pre-AASB forecast for us ranging between 17 and 17.5 EBITDA for this year. We don't normally go out with predictions, but we're saying at the moment that we're comfortable with those forecasts. And, we expect to see, obviously, civil infrastructure continue to be very strong for the next period of time. Finally, just to give it sort of round out what it is that we're really focusing on as the strategy now specifically for this year. Number one, as I mentioned, new clients, new markets, expand and promote the capabilities and expertise across the business, develop the national footprint for industrial scaffold, including potentially looking at acquisitions in this area. Now that we've got an online platform for sale of product, really growing that product sales with very strong focus. We've had extremely good early results from our online program. We want to make ourselves as easy as possible for customers to deal with when they want to buy rather than hire. In the commercial scaffold area, whilst we're not specifically looking to grow in that area, we know it will come back at some stage. What we're just watching there at the moment is what's happening with a range of competitors who are under a lot of duress. Companies that only do commercial residential scaffold are not having a good time. And there may be some opportunities for us to pick up some market share there fairly easily, and position ourselves for when that market does come back, as it will do sometime in the next few years. Continue to really focus on the engineering team and the capabilities of our engineering team. That, with our geographic spread and product range, they are the Acrow competitive advantages. And the last point, it's interesting to me, I've been running this business for 7 years now. When I started, we were probably the last port of call for people wanting to come into the industry. The company had a pretty bad reputation. I think that's the complete reverse now. We've been able to attract some very, very good people who've had a lot of experience working for some of our competitors in some way, and that continues almost on a 2 or 3 month basis. We're able to attract new people into the business with high expertise that are attracted to what Acrow can present them now. So that, I think, wraps up pretty much slightly over time potentially, Mark, but back to you now for any questions.
Yeah, we got a couple of questions. I know you're talking about organic growth opportunities. I just wonder, somebody's just asking about expansion into the New Zealand market, probably in the formwork business, I guess, rather than the scaffold business, given what you've said about it in the Australian market. Is that on the cards?
Look, we've got an eye to it. We strategically got the rights to the Ulmer products to distribute in New Zealand for that reason. We've had some discussions with companies over there. Look, we're not rushing into the New Zealand market, but certainly we have an eye on it. There will be an opportunity at some point, whether it be via acquisition or via partnership with another company, or just setting up some footprint ourselves. But yeah, we certainly have an eye to it.
Okay. And then another question around acquisitions, actually. Future acquisitions, is that more about getting access to products or access to customers and markets, or where would acquisitions come from or be targeted in the future?
Look, the next area we think is the industrial scaffold area outside of Queensland, because we've got this successful business in Queensland. We want to take that national. We can do a bit of that organically, but there are certainly opportunities for us to grow by acquisition in that space right across the country. It's a big market in WA, it's a big market in South Australia, so we've got an eye there. We probably now, in terms of a big consolidation style acquisition like Unispan was, that's probably not on the cards now. It would probably be, as you said, they're probably more to do with other products that are ancillary products to the suite. And look, we've got a couple of those that we're looking at the moment, relatively small acquisitions who have a specific product that we know we could and a channel to a market that we can open up and would complement what we do.
Okay. And then if you just go back to the slide, maybe on the margins, I can't remember, I think it was the 6th or 7th slide. Just a question on where you think margins can get to, like, over the longer term, or is this kind of the range that you kind of like to keep them at?
Look, it's an interesting discussion, because we were traditionally almost all of our earnings came out of hire and not much out of sales, and hire is sort of 100% pass through, really. As you grow your hire revenue, you don't drag a lot of cost along with it. Whereas obviously with sales, I mean, if we can make around about an average of 30% margin on sale of product, then we're doing really well. So, you know, what you may find is we will grow our profitability, and the actual margin may slightly shrink, because you'll have more contribution coming out of sales with a 30% margin versus higher, where it's basically 100% pass through. So look, I would like to think that we can maintain, you know, an EBITDA margin of between 15 and 20, but if we're at 15 to 16 rather than 20, it's going to be off a far bigger number, because that means we're going to have been very successful in opening up our sales business.
Okay, so it's down to sales mix. Just a quick question, and somebody wanted to know, what are the two brokers who do cover you?
Why are there two?
No, what are the two? Just
what are the two? Bell Potter and Morgans.
Bells and Morgans. Okay, great. I think somebody's probably looking for a note there. And then finally, I think that's it. I think that was the last one. Let me just double check here. Yeah, that's it. Okay, perfect. We're going to finish just on the hour. Steve, thank you very much for your time, and thanks everyone else from joining in. As I said, this recording, if you want to watch it back or check back through any of Steve's slides or Jim's slides, it'll be up on the YouTube channel probably by latest on Monday.